In today's video, we're going to explore two important terms you often hear in the world of investing: market capitalization and share price. While they might sound similar, they tell us very different things about a company. Understanding the difference can help investors make smarter investment decisions. So let's get started and clear up the confusion together. A company's worth, or its total market value, is called its market capitalization, or market cap. For example, if Apple has 100 shares in circulation and each share is currently priced at $50 in the stock market, the company's market capitalization would be calculated by multiplying the number of shares by the share price. In this case, 100 shares multiplied by $50 equals $5,000. Therefore, the market cap of Apple Inc. is $5,000, representing the company's total market value as perceived by investors. However, it is first established in an IPO, or initial public offering. Initial public offering is when a private company first offers shares of its stock to the public on a stock exchange. In preparing for this process, a company pays a third party, typically an investment bank, to determine the value of a company and recommend how many shares to offer to the public and at what price. For example, a company whose value is estimated at $5,000 may want to issue 100 shares at $50 per share. And when a company goes public, its shares start trading on a stock exchange. In there, stock price is determined by demand and supply of the stock, which makes the stock market similar to other economic markets. Demand refers to the quantity of shares investors want to buy at a given price, while supply refers to the quantity of shares available for sale. The interplay between supply and demand determines the price of a stock. If there is a high demand for its shares, the price will increase. If the company's future growth potential looks dubious, sellers of the stock can drive down its price. For example, if seller A owns a share of X Corp and buyer agrees to buy it for $50, they complete the transaction at that price, and buyer becomes the new owner. The price at which the stock is purchased becomes the new market price. So, after the $50 transaction, the market price of X Corp is now $50. When another share is sold, that transaction determines the latest market price. Suppose another seller wants to sell a share, and buyer offers $53 based on positive news about the company. If they agree and the sale happens at $53, then $53 becomes the newest market price of X Corp. This process continues with every trade, and that's how stock prices move in real time. However, the demand and supply is affected by a wide variety of factors. While it is impossible to consistently predict exact stock prices, general movements up or down can be inferred from certain information. Although market cap is often used to describe a company, it does not measure the equity value of a company. Only a thorough analysis of a company's fundamentals can do that. Also, it is an inadequate way to value a company because its market price does not necessarily reflect its worth. Market sentiment often overvalues or undervalues shares.